The SIPs, systematic investment plans, have been sold as the best way for retail investors to ride out market ups and downs. The idea is simple: invest a fixed amount regularly, and rupee cost averaging will smooth out the highs and lows, helping you build wealth over the time. Sounds great, right? But what happens when markets enter a prolonged downturn? History tells us that SIPs haven't always worked as expected. There have been long stretches like the time period from 1994 to 2002 and even for 2006 to 2023. SIP investors in mid-cap stocks saw little to no gains or even lost money. Despite the recent correction, investors continue pouring money into mid and small cap funds, often ignoring warnings about valuations. Are SIPs truly a safe bet in a bear market, or is blind faith in them leading investors into a trap? We caught up with market expert Sunil Subramaniam and even Anurag Singh, managing partner for Ansiddha Capital, to know their views. Listen into what exactly they had to say.
Volatile market, right? The rupee cost averaging that means that you buy more units when it's down and you buy less units when it's up. Now, the working of SIP depends on the maturity date of the SIP. Normally, SIPs are done to achieve certain goals, like a child's education abroad, or a wedding, or you want to go on a silver jubilee wedding anniversary cruise. So you save for a period. Now, if that maturity date happens bang in the middle of a bear market, right? Depending on when you started the SIP. So if you've done 5-year SIPs, there are equal chances that in the midst of a bear market, you would have lost your money relative to the amount that you put in. But the moment you stretch that to 10 years and 15 years and 20 years, even in bear markets, even if it started in the highest bull market, you still made decent returns. So I think that the answer, to be very simple, is that short-term SIPs less than 5 years stand the risk of you losing money if you're stuck with the maturity in the middle of a bear market. But if you see through the bear market, that investment in the bear market would have been your best value installment ever.
I'm very skeptical of experts and market gurus who say, stay for 20 years, you are guaranteed to gain. And in the same breath, people say past performance is not a guarantee for future. I don't think anybody can guarantee anything here, right? First point to note is, even if you say, oh, 20-year time, it has always worked because it has worked in the last 20 years, that doesn't hold true, right? So please be skeptical of that. First point. Second, Vikram, SIP analysis in India is a hindsight phenomena. Because nobody did it, market had prolonged bear phases of 7, 8, 10 years. Markets were extensively cheaped. If you virtually in the hindsight go back and allocate money at that level, obviously you will come out very rich today. It hasn't worked anywhere except India. Even there, experts are being disingenuous because they count 2002 to 2008 phenomena. The moment you take that phase out, even in India SIP, the case is very weak.